So this is pretty cool. We're doing a live webinar simulcast to Renters Warehouse existing customers. We have about 200 people that are registered for it. They're piling in right now. We're doing this because we're going to layer education into the experience of being a Renters Warehouse customer. But also there's so much nonsense out there in the media about the housing market that we wanted to give people not just a different point of view, but the actual supporting data behind it. The more you understand the housing market, the more you have confidence in it, and the more bulletproof your confidence can be when people in media who are clueless say the opposite. So I hope you like it.
Thank you, everybody, for coming to our first webinar of the year for our Renters Warehouse clients and homeowners. We're excited to have everybody here. And this is something we're going to start doing on a little bit more of a regular basis, as we've got some, we think, some great information to share with everybody. And as part of being a Renters Warehouse client, we want to make sure you guys are very educated on what's happening in the market from our perspective. And we also are very excited and very happy to have Greg Rand as part of our team. Greg joined our team January 1st, January 2nd, as our Chief Strategy Officer. He's the former CEO of Own America, an online technology platform that we purchased and acquired at the beginning of January. And I've turned that into our new Renters Warehouse Investor Marketplace, where many of you have probably heard about that and seen that. But as we continue to go throughout 2019, we want to be able to provide more education to everybody around how that technology works, how it can benefit you and your portfolio, whether you're looking to grow your portfolio of rental properties, which we're going to talk a bit about today, why we think that's a great idea. Or if you're looking to maybe sell one or two of your properties as well, how you can benefit from using the investor marketplace on that. But mostly, we want to have you leave today having a better understanding of what's happening in the marketplace when it comes to the real estate industry. There's a lot of information out there on the news and in the media with really conflicting stories. I think every week I read a story, Greg, that shows the real estate market's going to bomb out and crash, and homes are going to be worth $0. And then the next day I read an article about the great stability in the real estate market. Then the next day I read about the fact that we have an affordability issue and people can't afford to buy homes. And then the next day I read an article about how home prices are falling, and that's an issue. But really, that's fixing the affordability issue that I talked about or that I read about the day before, right? So a lot of conflicting information. And Greg has been studying the real estate industry and the data and the analytics around real estate for 20 or 30 years. I like to age him a little bit whenever I can, but
not that hard.
I think I said 2 decades once, and you corrected me to 3 decades. So he's been doing this a long time and has some great insights on this. And so we're going to start doing these on a regular basis. So we hope you enjoy it. Without further ado, I'm just going to turn over to Greg so we can get started on time. We're watching some attendees here continue to jump into the room. This will be recorded, so we can have access to it for everybody later as well. But we appreciate you coming, appreciate you taking your time, and we look forward to answering questions here. And hopefully everybody learns a little bit of something. So Greg, go ahead and take it away.
Awesome. Thank you, Kevin. Hi, everybody. As Kevin said, I'm a recent addition to the Renters Warehouse team. My business, Own America, was a platform for professional and institutional investors in the single-family market. For years, we helped a bunch of large Wall Street firms take big positions in the housing market. And as a result, we had to be dead on in terms of understanding the market space, understanding the data. It wasn't just about writing articles for us. It was about making recommendations to big clients and then not being wrong. So we actually made a name for ourselves in that space. It led to this situation where now Renters Warehouse is a full service real estate investment company. And I'm really happy to be here. So do me a quick favor. Someplace on your dashboard, as a user, you've got a little opportunity to put a high five up or a hand up. Just see if you can find that and click on that for me. Let me know that you can hear me and see me. And awesome. Okay, thank you. So it looks like everybody's found that. There's also a questions place, so feel free if you have any questions to pop those in there. I'll break away now and then and look up at that and see if there's something that I can answer along the way. And maybe I'll even unmute you. So if you wanted to be unmuted, you can say that in the question, so you can actually ask the question verbally, which makes it feel a little more like a TV show or a radio show or something fun like that. So, all right, let me jump right in. Yeah, the reason why we're kicking this off is because we wanted to layer in education and information because we do immerse ourselves. I mean, none of us have any hobbies around here. We immerse ourselves in the housing market and all things investment. And we've been treated for the last 12 months in particular with just a drumbeat of conflicting information. But the one thing it tends to have in common is that it's negative. And so we just want to share the full picture with you and show you the reason why our big Wall Street clients are still buying. Companies that spent billions of dollars buying homes are raising more billions and buying more. And I'm not making that up. And so I want to share with you what they know and what we've shared with them because we study the same data. And the reporters that write these stories typically don't know. So my mission is for everybody who has an investment portfolio or wants one. And by the way, a portfolio can be one house. But anybody who has a rental portfolio in the country, that they learn these principles themselves because they will be led astray by anyone from a media person to a guru at a seminar. So here's the real scoop. I frame this as the 5 principles of real estate wealth because I spent my entire adult life in this business, and I've noticed patterns among some of the most successful investors beginning back in the 80s and not the 80s. I go crazy dating myself here. Beginning back in the 90s into the 2000s, I was immersed in commercial real estate investing in and around New York. And when I moved over to residential, because I like it better, I like betting on basic population trends as opposed to business trends and other things that commercial real estate plays in. And I moved over to residential investing completely. The principles held. And so the first one is timing is everything, but that's a bit of a play on words. What I mean by that is giving yourself a lot of time. The stopwatch is the wrong image for this, actually. It should be a long path of years and decades in the future because you can avoid making mistakes with timing by just not making short-term decisions. That's really what timing is everything is about. But let me start with this quick thing about our friends in the media. This was an article that Inman News, which is a real estate news publication, came out with late last year, where Zillow, as you know, the big portal in real estate, had a panel of experts that predicted a recession will hit in 2020. Now, this was like the press release that launched a million ships because every media outlet on the planet ran a story. If you go search Zillow recession 2020, you'll see dozens and dozens and dozens of pages of articles spun out of this press release. Here's the problem. The subheading on this says nearly half of experts surveyed said they expected a recession. That means that more than half of the experts didn't think that, but that didn't make the headline. This was disappointing to me because these are people in the real estate business. I'm not sure why they would take a survey and then report what the survey didn't return. The majority of experts predicted that the recession would not hit for years to come, but some of them said it would, and that made the headline. And what you'll figure out pretty quickly is that when you go and search Google for recession stories about the housing market, you'll see pages and pages and pages of results. If you search for good news, you won't find it. And so whatever the motivation is, good. If you're in the media business and you want to get eyeballs on your articles, you write negative news about housing. If you write positive news, it's perceived as being Pollyanna or just not on the right side of the issues that they're trying to impact, the opinions they're trying to shape. All right. So what happened next is that last year we had stories. This is a recent one at the end of the year. Americans stopped buying houses in 2018. That wasn't true. Mortgage lenders are getting crushed. Not really. This is basically that home sales slowed down and mortgage rates went up. And this is the way the headline played out. And of course, they chose an image of a collapsing building. The first line here, housing took a dark turn, like it's evil. All right. So I'm going to show you in a moment the actual stats behind all this, but I wanted to make the point first that when you see things like these superlatives, these images, economic crisis on the previous slide was not from the article. That was a stock image that the news service chose to use. There's no crisis predicted anywhere in here. It was a recession, but they used economic crisis. So, you know, a lot of headline readers see that, get real nervous. They see this, they get really nervous. I got nervous and I knew better, you know, a collapsing building. And then, you know, terminology like a dark turn. And here's one from just a week or so ago where the average home lost a certain amount of value since August. This was at the very end of 2018. And so it's pretty universal. And so I want to share with you some of the data, and we're going to go through the housing cycle to explain what happened this year. Because this was a shifting year. They are right about one thing, is the market is going through a shift. And the reason it's going through a shift, I'll play out. These are the narratives that came out starting about a year ago in the first quarter. Narrative number one is bad news for housing because affordability is low. Affordability is low is what it sounds like, right? People can't afford to buy the houses. They've gotten too expensive, right? So now what happens in a healthy market, in any supply and demand situation, is that when the prices go too high, the demand falls off a bit until the prices cool off. All right. So like it was interesting that it was bad news that affordability was low, because if you owned real estate, affordability being low translates into your property being worth more money. So that storyline found the aggrieved party, which was the person who wanted to buy your house, instead of the non-aggrieved party, the person who's benefiting from all this, the folks that own the house. And I'll just point out something absurd. You've never heard them talk about the Dow Jones is up today, so affordability on the stock market is down, and that's bad news for the stock market. That's never been said. So that was the beginning of the year. Affordability is low, that's bad. Then what started to happen is what typically should happen, is that if the prices are getting too high and people can't afford them, they don't buy them, right? So home sales decline. The number of houses that actually sell declines. And what I want you to picture is a seller who is in the catbird seat. The seller is raising the prices. They're raising prices. They're really in a great spot. And then eventually the buyers say, like, enough's enough. I'm not going to pay these prices. And you have a bit of a standoff. So home sales decline necessarily because affordability is not good. And then what happens is inventory begins to accumulate. Okay, there's more houses available on the shelves because the ones that came on the market last month and the month before haven't sold yet. Common sense, right? So affordability is low, prices are too high, sales slow down, inventory accumulates, and they don't begin to sell. The houses don't sell, the buyers don't act until the sellers come to their senses and they acquiesce and they stop raising their prices so high, right? And so what happens is you see home sales decline, you see home prices begin to level off and potentially decline, right? So the question is this decline from the previous article, is this an indication of the market crashing because we have the first indicators of price declines? Let's see what you think when you see the real data. So this is a chart from the National Association of Realtors going back to 2014. And let's just focus on 2018, which is the last part of the chart. So right here, where my arrow is where those articles began being written. And this is the number of homes selling, not the prices, but the number of homes selling. And you can see that it's true that home sales were declining. Okay? So these are the buyers being stubborn and the sellers being stubborn. And so houses accumulate, houses don't sell, home sales are declining. You can see that it's hardly a historic event, right? I mean, it's right in line with the way it's been going back as far as this chart goes. And it's in line going back many, many, many more years before that. So this is not some kind of a catastrophic event. It's simply the market behaving in a healthy way where supply and demand were out of whack. And then in the last couple of months, you see a sharp decline. So there are articles in the last few weeks about how home sales plummeted at the end of the year. They plummeted, they plunged. I want to point something out. This is the plunge. Looks pretty scary. Let me go back to last December. There was a plunge last December too. Okay, from the fourth quarter basically is what this line right here is. Okay, you go back to the previous fourth quarter, smaller plunge. Maybe this is a plummet instead of a plunge. And then you go back to the previous one, you see a much bigger plummet. All right, and the point is that it's called holiday season. All right, homes don't sell as much in the fourth quarter because it's cold and people are busy with all that holiday stuff. That's it. So there's a lot of common sense around this. There's not a lot of common sense around people. And by the way, you don't have to have common sense to look at this thing and say, if every single November, December home sales plummet, maybe they're just a seasonal thing. And it's not the end of the world, and it certainly isn't here. Okay, this is not going to continue. And it's going to be funny to see when the first quarter numbers come out and they pop up, what is going to be the story then? It's not going to be, yay, the housing market's healthy again, home sales are soaring. They're going to find some other thing to go negative on. So be ready for that. All right, so that's home sales. One of the reasons why things get real negative when home sales decline is that realtors get real complainy right about then, because they make their money not on how much the houses are worth. I mean, their commission's tied to that, but they make their money based on how many sales there are. And so I know a lot of people in real estate who talk about the real estate crash of this or the real estate crash of that. And what actually crashed was their real estate business crashed, but the real estate market didn't. Just home sales stifled for a bit as the market found more balance. Okay? Give me a high five if this is fun so far. Right? Doesn't matter what you do for a living or where you live, but beating up on the media is just fun, isn't it? Kevin, I got a lot of high fives on that one. Next chart, this is home sales. I'm sorry, this is prices. The median price of existing home sales, also going back to 2014. So the article I just showed you talked about home values going down since August and how that is the worst thing ever and it's terrible and it's horrible, except for home prices are always at the lowest point. Look at this little heartbeat. Winter, okay, I'm sorry, summer, winter, summer, winter, summer, winter, summer, winter. Same explanation. So if the writer in this story chose to look at this chart, they would realize that it would be silly to write an article about home sales going down between August and November, because home sales always go down between August and November. Demand subsides because of the holidays. People are rushing to get into houses before the school year starts. The spring market is the thing. People come out of their shells. A lot of folks here from Minnesota, you come out of your shells, right, when the weather comes nice again or becomes nice again. People start buying houses. They need to get it done before the school year. Then it cools off, and then everybody goes into the deep freeze of the holidays and so forth. So just be aware of this. You now know something that apparently every reporter in America doesn't know, which is that home sales and home prices tend to go down in the fourth quarter. So congratulations, you are among the most knowledgeable people in America on the nature of the housing market. So what we think is happening now is that this interplay between supply and demand, which is causing home sales to go down, which is causing home prices to level off, is still going up. Okay, but we think they're going to level off. And then what's going to happen is home sales are going to increase again because the buyers are going to be satisfied they're getting a decent enough deal. There's nothing on the horizon. I shall go to the next slide here. So it really, really helps to even take a longer term view of all these things. Okay, so here's as long a term view as I can find. This is the Great Depression through the Great Recession. And this is according to the US Census. And I'm not making the point that home prices always go up. I'm just making the point that they pretty much always have. And I'm a student of history. And you can see, if you just drew a line to establish the trend line, you can kind of see that something was wrong in 2010 decade, right? You can see. If somebody showed you this towards the end of the decade, you might say, we've kind of exceeded the trend line here. Maybe this is not a good thing. And you would have been right. Here's a similar chart that shows the last 50 years. This is according to the National Association of Realtors, okay? And 68, this is an interesting chart because what you see clearly is a trend line established, and then that trend line is deviated from on the upside. This right here, folks, this was the problem. This was the correction to the problem. So the housing crisis was a result of something that was done by human beings, self-inflicted wounds, in the early part of the 2000s. So before I get to that, I think it's interesting that you talk to people about the real estate crash, people who know. My mom, who I love very much, who has been in real estate her whole life, swears about the house. I can show her this chart until I'm blue in the face. She doesn't buy it because she remembers how bad everything was back in 1980 and 81 when the economy stunk and there were lines around the corner to buy gasoline and interest rates were 19%. Except the problem is the home prices didn't decline back then. The real estate crash was for people who sold real estate for a living, all right, because nobody was buying houses because the rates were too high. So, Mom, if you're listening, I'm not talking bad about you, but you got to look at the chart because you'll see that it's unmistakable. There was also a big real estate crash in 1990s, but except there wasn't. There was a crash in home sale activity, but prices leveled off. In both of these cases, the rate of appreciation leveled off. The rate of appreciation leveled off, and then we shot off the chart here. In the mid-2000s, this was all based upon one thing. There was a lot of parties to blame, but it was one thing, and that was called funny money in the pockets of buyers. Okay, lenders started using computers to underwrite loans, and then you probably saw The Big Short. You know that there was a big emphasis by government and by the banking industry to put loans out to anybody the robot qualified for, right? So the robot was qualifying mortgages, not people, and they kept loosening the lending standards, loosening them, loosening them. In fact, I was in the real estate and mortgage business my whole life, so I was then too. And I remember actually saying out loud to a sales meeting full of mortgage officers that in a mortgage company that I ran in the 2000s, where we were told on the speakerphone that we were now going to allow people to make only 20% down payments, and they only had to have a 680 credit score to qualify for sign and drive. Whatever you say you make, you make. We're not going to verify your income. Then 2 weeks later, same conference call, 640 credit score, 15% down. 2 weeks later, 620 credit score, 10% down. They kept loosening the standards. So what you had were people running around shopping for houses. Prices were running amok. And, I wanted to buy a $300,000 house, but I've got a blank check in my pocket for $375, and I'm going to bid $375. That's all it was. That was the behavioral pattern on the ground, that people believed the robot that they could qualify for $375, so they bought $375 and it artificially escalated prices. So again, everybody can blame anybody they want, but that's what happens. And the artificial exuberance, the irrational exuberance, drove prices to a point where the market had enough, and it came back. And the analogy that I like having in my mind when it comes to what happened here was that movie, The Revenant. You ever see the Leo DiCaprio movie, The Revenant? All right, The Revenant had a grizzly bear as the protagonist, right? And there's a scene where the grizzly bear just beats up on Leo DiCaprio. I mean, he's stomping on him, and he's clawing him, and then he's chewing on him. And then he takes a break and looks around and sort of takes a little rest. He's still standing on him. And then he starts beating on him again. And that, I immediately saw that and said, that was the housing market beating up on all of us, right? The housing market woke up from its nice, gentle slumber, mauled everybody, and then went back to doing what it was going to do. So this correction was something, by the way, I wrote this book back when the market was on its way down. This is called Crash Boom. I believed the market was going to come back. I was a little bit rare. Kevin believed it. I believed it. A few of us built businesses around a market that would recover. But this chart, this line right here in the chart is this line right here on this chart. So I predicted flattening and then increase. We got flattening and increase. So I'm very happy that I actually did that on the cover, because now I'm on record with it. And it was a lot of investment activity that created so much of this recovery. But anyway, the point is, you look at this trend line, we deviated, we corrected, we're back on the march again, and I think it's a little bit high. Have to admit, right? The prices have gone a little bit high, but if you look real close up here at the end, it's already beginning to level off. We were talking all the way through 16, 17, and 18 that prices should not go up this high. They should level off, and they're going to level off. Heaven forbid the government intervenes. Heaven forbid anybody intervenes. Just let the buyers intervene. Let the buyers say, enough's enough. Sorry, New York thing. Enough's enough. We're not going to go any further. And so already you see it leveling off. I think we're going to see a period now of modest 3 to 4% annual appreciation, maybe even sub 3, 2 3/4. It's been 3.4 for the last 20 years. It's going to be 3.4 again. But in the last couple of years, it was 5. It was 6. Too high. But it's not going to plummet. And the reason it's not going to plummet is that the circumstances here were way overinflated prices and an economy that tanked. And right now, we don't have an economy tanking. We have very strong consumer confidence, very strong employment, and really no end in sight, with the exception of reporters that seem to have a horse in that race. But the numbers don't reflect that. So I think we're going to see leveling off. And when you stand here in 20 years, I'll look at this chart, you're going to see this little bump in the middle, and then it's going to kind of just continue to gradually go up. When you hear people say the market is cyclical, they are correct. But sometimes they say it's cyclical, and then they say what goes up must come down. And that's when you got to stop them. That's not the case. Now, you can find isolated markets around the country where that might be the case, that things bounce a little bit. But what goes up does not come down. What goes up gradually keeps going up gradually. If it goes up too steeply, it's going to have to give some back. But it's going to go back. If population trends stay strong, then we're good. So the cycle is what is really, really important to understand, so that you get a feel for when you start to see people's behavior changing in the market. And you can see that. You can talk to friends. You can get, like you probably know, from a barbecue you were at last summer, when somebody said, oh, we're trying to buy a house, there's nothing to buy. There's no inventory. You catch a little story on the news, but there's nothing to buy. There's no inventory. You know, just by living in the world, it's coffee table, a cocktail party conversation, right? So when you can get a read on human behavior, you can get a read on where we are in the cycle. So, oh, my slide did something weird here. This is the pendulum, right? The market cycle operates like a pendulum. And the S and the B represents the seller and the buyer. And when I translated this slide, the S and the B got out of whack. What's supposed to be the case is the S is super big on the left and the B is super small. And then the opposite is true over here. You can see in the middle, the round balls, the size of the S and the B are changing. When the B is big, the buyer's in control. When the S is big, the seller's in control. Buyer's market, seller's market. So we're going to talk about both of those. And this is an interesting year to be doing this because it's just happening as we speak. This material, by the way, just so you know, is part of a professional certification that my company offered for 9 years to teach real estate brokers across the country how to serve investors, because we had these big Wall Street investors that we were serving. And so we had a professional certification for people to be in the residential investment space. That is now the Renters Warehouse, or actually we're calling it the Rent Estate certification, Rent Estate investment certification, using the title of Kevin's book, Rent Estate Revolution, as the brand. And we're continuing to teach people, but you're getting a slice out of that education here. And we'll carry different modules of it throughout the year if you want to keep tuning in. So here's the deal. When the pendulum is straight down, we've got a balanced market. All right, everything's good. The seller and the buyer are on level footing. All right, and that's what you want most of the time, because nobody's at an advantage, but the pendulum does swing. So what happens when you've got a seller's market and the S is supposed to be huge and the B is supposed to be tiny? We've had a seller's market for a few years now. And the way that looks is, picture the seller, the king and the queen on the throne, and the buyer is bowing and scraping and coming in and asking if they can please overpay for that seller's house. All right. They even had something in the real estate business that we refer to as the letter. Just you ask any realtor about the letter, they know what you mean. The letter is, dear homeowner, we felt so much love in your home when we were touring through the house during the open house, and we hope that we can raise such wonderful, well-adjusted kids as you did from the pictures that were on the mantle, that everybody here is so happy, obviously. We'd love to buy your home. Please let us overpay for it. Realtors actually have their buyers write letters to try to appeal to the hearts of the sellers. That's when things are extreme, right? Bidding wars and so forth. So the behavior patterns there is demand is super high. Inventory is low because all the houses are getting bought. You've got bidding wars. You've got the transaction count is high because sellers are selling and then moving up. Buyers are buying. Things aren't staying on the market for more than a few weeks. Sales prices are being driven up because buyers are outbidding each other. And so the question is, when does it actually shift back? When does it shift back? So this is December of 2017. Then all of a sudden 2018 came along and the prices got up until the prices went up until the buyers resisted. That's when the pendulum begins to break loose and swing back the other direction. So in this situation, demand begins to decline, which was happening in the first half of last year. Transaction counts decline, as we talked about. Inventory increases. Sellers buckle and drop their prices, and then sale prices flatten. All of this material, by the way, has been in our certification course for the last 9 years in one way or the other. We just happen to be living through a perfect illustration of exactly that. So we've gone through that now. We're in the middle of a balanced market right now. And so here's how that looks using this long-term chart as an illustration. This was a seller's market. Prices going up, buyers being irrational. This was a momentary balanced market, and then it swung to a buyer's market. All right? And then it swung to a balanced market for a little while. Now it was balanced because the buyers really weren't buying so much. The sellers had come down on their price, and the market was kind of trudging along, trying to find its bearing. And then we got a seller's market again, all the way from like 2012 or 13, all the way until just recently. And now we've got a buyer's market, now we've got a balanced market again. And the question is, are we going to shift to a buyer's market? All right, and what does that look like? So if we're going to swing up to the other side of the pendulum to a buyer's market, the demand has to be low, meaning buyers no longer want to buy or can't buy. The inventory accumulates, and you wind up with lots of houses on the shelves staying on the market longer, and so the transaction count is low, and realtors are crying because they can't make a living. And by the way, I love them, so I'm teasing them, like I would tease a fellow New Yorker. I'm a Southerner now, by the way. I'm a recovering New Yorker. I am a North Carolina guy now. I know you can tell. Sales prices dropping. Okay, this is a buyer's market. The shift to the next phase is when buyer demand fires up again, confidence comes back to the market. That's what happened back in 2011, 12, 13, 14. But to have confidence come back, it first has to go away. And right now we don't see evidence of that being a problem. So going back to this, sellers balanced, buyers balanced, sellers balanced. Where we sense that we are right now is we're not headed towards a buyer's market simply because we're at full employment. Confidence is strong. Discretionary income is strong. Wages are going up. So if somebody were to buy today, they would not likely see a pop in property values like 8% next year. They're going to see 4 or 5%. I can't guarantee you anything, but my reputation's on the line that home prices are going to go up in 2019, and they're going to go up in 2020. And I don't think we're going to have a recession in 2020 unless something drastic happens. Massive tax increases could be something drastic, for example, right? So something like that could cause the market to go in a different direction. But right now, this is a healthy thing, driven by population growth, driven by general consumer confidence, and all of those things are intact. Now, let's say we do get one of these wicked buyers markets in the future. All right, let's see, do I need this slide? All right, if it does go back the other direction again, it's because the demand increases, the inventory declines, the transactions start flying again, okay, and the sales prices begin, if they're going down, they begin to increase. So what happened that last time around is prices were going down until they hit a bottom, and it was actually investors. It was actually you and my clients that were buying properties at the bottom in 2011 that actually pushed the market back up again, okay? But I feel really comfortable and confident in the fact that if you have this idea in your heart that timing is everything, and again, what I mean by timing is everything is really geared towards letting a lot of time pass before you expect your investments to mature, right? Even if you bought at the peak, just popping back to this again for a moment, if you bought here, you had bad timing, especially if you wanted to hold it for 4 years. If you bought here and you're hold on to it till today, if you had a 25-year threshold, right? This was a retirement account. I mean, I bought property in the early 2000s on the way up, all right? Even though I knew it was getting very hot, I like to buy property in places that I think, despite any economic headwinds, are going to rise, because Amazon opens a distribution center in town, or the Panama Canal expands, and as a result, the port of Jacksonville is cranking up all this dredging and opening up, more shipping lanes, or Western Pennsylvania discovers, shale fracking preserves and becomes a big energy hub, right? Those are the kind of things that get my money when there's mega trends that are happening, that no matter what happens in the national market, I know I'm going to be okay. But what's happening in the national market here doesn't cause me any concern. I'm going to take a pause for a second and see if there's any questions. If you've got anything on this, if you think I'm full of it, let me know. Let's talk about it, right? You're customers of ours, so I have to be super nice. It's not like what I would do on LinkedIn to some stranger. But give me a hands up if this is helpful to you so far, right? I mean, I'm trying to make it so that you folks get a sense of what's happening in the market. So, like, you own real estate, right? You may own the house you live in, and then you at least own some rental property because you're on this webinar right now, and you may be looking at all these headlines and wondering what's happening, right? And if you want to sell, that's fine. In fact, I'll mention it now. If you do want to sell, we're a real estate company now, and so what Own America perfected, and we were one of the only companies even attempting it, is selling properties, rental properties, with the tenants staying in place. That was a pretty cool move that we made, right? So instead of, when you go to most realtors, they say you want to sell your house, you have to get the tenants out first, which means you go from making money to losing money, and you probably have to spend a few dollars to dress it up for the retail market to sell to a home buyer. But we're specializing, always have, and selling properties that are already occupied by a tenant. So like think if there was like an office building that somebody wanted to buy that was fully occupied with tenants, you wouldn't want to vacate it first to sell it to you, right? You want to leave it intact. So you as an owner can sell the office building, you make money all the way to the closing. Me as a buyer, I buy the office building, I make money from the closing forward, and all the tenants don't get kicked out. That's what we do. So if you do decide you want to sell, that's cool. I know that you'll make money over the next 10 years, but you might be saying, hey, we did great. I held my property through this crazy period of time, and now I've made a good return. I want to get out. That's great, but call us because we can start marketing your property while your tenants are still there, sell it with them intact so they get to stay. You get to make money right to the closing. And if it turns out that you do want to vacate the property because it's actually worth more to somebody who's going to move into it, which is sometimes the case, often the case, we can begin marketing the property even though the tenants are living there because we can tell them what's happening. We're the ones that are going to notify them that they have to vacate when the lease is up, but we can arrange for access. We can arrange inspections and photographs that other real estate companies really can't do without coming to us anyway. We can do it in more of a stealthy way, in a less intrusive way, and handle that for you. So it's your property. Do what you want with it. Let us help you either way. Okay. Let's see. Tim Peterson, considering buying a winter second home in Florida, a condo. Is it a good time to buy in Florida? If you're looking to hold it for a long time, yes. What's happening in Florida is that the market, this chart right here, was even more dramatic in Florida. Where are you thinking in Florida, by the way, Tim? Give me another bit of info there. It was even more dramatic. The market shot up. It shot up so hard that it came down very hard, but it's fully recovered right now. And here's an analogy I love, right? Two forces of nature, a forest fire and a glacier. Okay? The forest fire seems like the most forceful, powerful force of nature you could ever come across if you're close to it, right? It's raging, it's violent, it's terrible, right? But if those two things met in battle, a glacier trudging along slow and steady, and a forest fire, who wins that battle? The glacier wins the battle every single time, right? There's no contest. The glacier for the Florida real estate market is the population migration out of the more expensive, colder climates in the Northeast and upper Midwest coming down to Florida. That hasn't changed. Cost of living is better, quality of life is better, no state income tax. That's the reason why Florida now officially has more electoral votes than New York. Okay, that didn't change. What the forest fire was too much speculation during the housing boom that it had to get put out by the glacier. It has been put out by the glacier. So you're mentioning Sarasota. I know the west coast of Florida real well. I grew up going to Sanibel Island just south of Sarasota. I had my honeymoon down there. My mom lives down there now. That market is great. It's absolutely great. Just don't flip properties there. Okay, buy them and hang on to them. All right, let's see what else we got here. Okay, so I'm going to read this one out. People actually live in these homes, but new players to get in can't afford the funny prices in a first-time home buyer market. If the rent is so high, they can't save any for down payment. How does that influence liquidation versus always needing to keep your money in it if you need to live somewhere? I'm not sure I understand. Would you want to downsize your personal home or just live in the increased value, even though that might mean, you know what? I think Benjamin, where's Benjamin? Benjamin, how do you feel about me unmuting you? And you can ask me that question live on the call here because you wrote a lot and I don't quite get it. So I'm going to unmute you in 3, 2, 1. If you are like in a carnival and it's too noisy, I'll just mute you again and I'll do my best. But I'm going to unmute you in 3, 2, 1. What's up, Benjamin? Can you hear me?
Yeah, I can hear you now.
Hey, how are you?
So, good. So a lot of times in various cities, they have this idea of urban needs to be uptown and gentrification. And then you have politics and social changes that go into whether or not a train gets built. And that can really change whether or not you want to invest in something that might in the future become an uptown versus a crime central, which it might be for next decade. So some people are trying to liquidate their homes or they have a setback. But if you've got your money in a house you're trying to live in and you see the market shifting, how are you going to try to shift kind of like a shell game then to make sure you're not in something that's becoming a crime zone if it's going to take another decade.
So this is the house you live in. And so the question is, if the market is shifting and working against you, what would I do in that situation to try to take advantage of a better opportunity to use the house that I live in as a wealth creator?
Yeah.
Okay. Yeah, it's a good question. Number one, right now, generally, it's going in one direction. Tough neighborhoods are being gentrified, or they're not being gentrified, but there aren't that many neighborhoods that are safe neighborhoods that are getting less safe. If you find yourself in the path of neighborhoods that are going the wrong direction, you always have the option to make the move. And you mentioned a train station. I'm not sure if I mentioned that earlier, but that's one of my things also. I like seeing where mass transit is going because real estate values almost always pop when more people can get to work easier and faster from a new location that didn't have the mass transit before. So, in the end, you should think of your monthly payment that you make on your house as capital that has to go somewhere, right? We want to live indoors. We're going to have an expense associated with having a roof over our head. You can thread that capital, channel it through something of an investment strategy, like picking places that you think are going to pop and then moving to them. Now, it's inconvenient to have to move as part of your investment thesis, but I know people who do that. I know people who buy houses that are in bad shape, fix them up, and then sell them and move on. I know people that have moved from, like my brother was in Upper West Side of New York, which right now sounds great. When he bought there, it was when Central Park was really super dangerous. He was a half a block off Central Park. Now, in the late 1980s, half a block off Central Park was lousy. In 2009, when he sold it, or whatever it was way after Central Park became, just a blessing to everybody on the Upper West Side. So he ended up moving from there to a condo from a developer that was going bankrupt. He bought the condo at a very cheap price, lived there for 5 years, and then moved out and bought a house that needed to get restored, and he bought an antique house. So he's parlayed his primary residence into a snowball of wealth. I mean, literally, the guy started with a $200,000 condo in New York, and now he's got a $3.5 million house. And he really did that by parlaying. So thank you, Ben. Did that answer your question?
Yeah.
Okay, cool. I'm going to mute you again. Thanks for thanks for calling the Greg Show. Let's see what else we have here. Monitoring public pension funds for retirees, the trouble many pension funds are in, and the future reduced retirement benefits. Yeah, this is a comment about, I think this is favorable towards real estate investing, Tim, because you're talking about, people are starting to realize that relying on Social Security, relying on pensions could be scary, right? How many more states or cities or companies have to renegotiate their pension obligations to become solvent before people realize that maybe that's not the only thing you should depend on? And we think rental houses is the best thing because they appreciate over time and they generate income. And so what we're doing here with the new Renters Warehouse is building this real estate company on top of a property management company. Is really the vision is like we're like Charles Schwab meets Remax, right? It's a real estate company, but it's a financial services office. You come in, you talk about how old you are, when you want to retire, how much money you have saved, how fast you can save, how many houses you want to have paid off when you're 65, and then put you on a path to go and do that. And by the way, we'll help you design your strategy. We'll also help you execute your strategy, and then we'll manage the property for you over those decades. And so we think it's like an awesome business plan, as simple as can be. And that's the reason for it, because more and more folks are realizing, like, the wrong person says the wrong thing on CNN or Fox News, and the stock market goes down 600 points. Like, no, thank you. So real estate is hard, so we're trying to make it easy. All right, let's see. What do we got here? So since Renters Warehouse is now selling houses, I have had tenants tell me that Renters Warehouse is trying to steal our current tenants when you go to renew them for the next year by trying to place them in new homes. Is that true? No. That would be me doing that. And I don't even know how to begin to do that. No, we're not trying to steal tenants. Tenants are actually easy to come by. So whoever said that, have them give us a call and let us know what they're hearing, because we have never made a phone call to a tenant, try to pull them out of one of our houses into another. Now, if somebody wants to sell their house and they've notified their advisor that they're selling the property and they want to vacate the house to sell it because the realtor they hire doesn't know how to sell a house with a tenant in place, that could be what you're talking about, in which case the tenant is calling saying, yo, what am I going to do? I'm getting kicked out. Can you find me something else nearby? And of course, we try to oblige that. But that's part of the reason to be selling the houses occupied, is that it's not that cool. Like, I'm disappointed in the real estate industry. I grew up in it. I'm disappointed in the realtors of the world who haven't been able to figure out that you don't have to kick tenants out to sell houses. So if you do the math, and I have, there's 160,000 families that get displaced every year because landlords want to sell the house and realtors only know how to sell a house one way, and that's vacant. It's a lot of families getting letters in the mail saying you got to go. You paid your rent on time, too bad. You took care of the house, too bad, you got to go. I don't care that your friend's best friends with the kid on the cul-de-sac. I don't care that your kid loves his teacher. You better find someplace else to live because I want to sell the house. The owner is not to blame for that. They want to sell. That's their right. It's really the real estate industry who never really paid attention to investors or tenants in any kind of serious way. So they allowed that situation to persist, and we're solving it. Let's see. Oh, this is a good question from Joe. How do the fees compare when selling your house with Renters Warehouse rather than your local realty office? They're going to be comparable, maybe a little bit cheaper. The difference is going to be that we're going to reduce what's known as friction costs. Friction costs is what happens when you have to vacate it first, and you have losses of income. And maybe you have to spend money. We're going to try to sell it occupied, but even if we can't sell it occupied, as I said before, we're going to be able to begin the process while it's still occupied, so that ideally, even if it goes vacant, it's practically sold. When it goes vacant, it's in contract already, and then the new buyer can close on it. So we're not winning this battle on being a low-cost provider. We're winning the battle on being the most efficient provider that can do everything while it's intact. Yeah, Tim makes the point that the tax code seems to bode well for the rental investment market. The only thing about the tax code that really affects the housing market is that in some places where state taxes and local taxes are super high, think New York, Connecticut, California, they can't deduct all of that state tax off of their income tax. So it winds up having a suppressing effect on the financial benefits of owning a home. That's not the case in places where I remember the cutoff is either $8,000 or $10,000 a year in property tax. Anything above that you can't deduct. What's really happening is the housing rental market is gigantic and huge. There's 16 million rental homes in America right now. 12% of the households, 12% of the households in America live in a house that they rent that an investor owns. 12% is as many households as drive SUVs. So if you notice some SUVs around, that's the proportion of people that live in rental houses. We just never knew it was that prevalent until we decided to measure it 10 years ago as an industry and saw it there. So the overall economy doing well tends to benefit home ownership. Right? People are more confident. They want to buy homes. They're making more money. But it doesn't bother us because it's not a zero-sum thing. Right? At the peak, 30% of the households in America rented. So it doesn't matter. I'd rather see the economy go well. But what I know is that if the economy goes poorly, put it this way. When the economy goes well, we win as property owners because the values go up and we're able to increase the rents. When the economy goes poorly, we win as rental property owners because rentals are in more demand. So even if our property values flatten out or, Lord forbid, go down, we're still okay because we have cash coming in rents. Okay? All right. All right. Let's see. I'm at 45, 50 minutes here. So any last questions before we go? Can I get a high five if you liked this and found it worth your time today? Yes, this is me fishing for compliments. I'm looking at a little camera eye right here. You can see me, but I can't see you. So all I've got to go on is your high fives and your questions. So, hey, thank you very much. If we could be of any help, contact your local office. Contact me. I'm grand at renterswarehouse.com. That's correct. It's grand at renterswarehouse.com. I'm really excited to be here. We're excited that you guys are our customers, and we are here to help. All right. Have a wonderful day. Thank you for being here.